Good morning, everybody, and welcome to the Daily Energy Markets podcast. It is 10:30 a.m. UAE time, and we have Brent crude oil trading this morning just with their nose below $70 a barrel, down about a 0.25% after closing yesterday above $70 a barrel for the first day since the depth of the Israeli war on Iran, and it's back up to that dizzying heights of $70 a barrel. Will it stay there? Obviously, everybody wants to know. Let's kick off this morning with Maliha Bengali, founder of MB Commodity Corner. Maliha, clearly last month, when we saw prices soar to 70 and above, it was driven by the sort of uncertainty what threat the Israel war in Iran would have to security of supply coming out of the Gulf. That dissipated when the war ended. What's driving it back to $70 a barrel now?
Thank you, Sean. It's great to be on the platform again. I think people are now worried about a few things. The pressure on the Fed to cut rates from a macro perspective, and also from the U.S. debt ceiling increase. I don't know if you have seen, but last weekend the U.S. Senate and House passed the U.S. debt. They raised the debt ceiling by $5 trillion, but also the deficit spending is a lot worse than expected. There's a bit of an inflationary boost to the market, and I think on back of that, people are getting a little excited about commodities as they're the pure beneficiaries of a inflation drift effectively. From the oil market perspective, obviously there's a lot of belief in the demand picking up. There's a lot of front loading of a potential demand pick up at the end of the year. We don't see that. So I think there's a lot of speculation coming to the markets in either copper or oil or other sort of asset markets, because we've seen gold, silver, and precious metals do really well. And there's talk about the liquidity feeding into the commodity cycle as well. It may be a bit preemptive in our thinking, but I think that's what's driving the oil market right now from a purely speculation perspective.
Clyde Russell, Asia Commodities and Energy columnist at Thomson Reuters. Where's the demand side of this push back to 70, Clyde? We've seen news overnight by the weekly inventory data, the first data point in the US, followed by obviously the EIA comes next, a little bit more reliable. But the first one by the American Petroleum Institute is at 7+ million barrel build in inventories, and yet oil prices hovering at 70. Is this a demand story now? China's back?
Oh, I think that's a brave call to make. Certainly,
I'll throw it out there anyway.
It's almost worth to have a look at these things. I mean, you're going to get a few history lesson numbers that actually look relatively strong. So next week we'll get official Chinese data on June, and that will give us first half official numbers. June looks like it was a quite strong month. All the tracking services say, imports by China of above 11 million barrels a day. You might even see a fairly strong July. But then by August, you're going to start to see the impact of that price spike we had with the Israel-Iran conflict in June. And the Chinese are a very, very strong track record of trimming their imports when prices spike. They're happy to dip into their own inventories. So I think, to say China's back is a bit of an optimistic thing to do. China is always there if the price is right. So if the price is low, they will buy and they will stockpile. And they've shown that consistently over the years. But as soon as they see that the prices are getting a little bit too high for them, they just trim back. Not massive amounts, 500,000 barrels a day, maybe even as much as 1 million barrels a day.
It's still solidly over 11, right? It's still solidly in and around 11 million barrels a day of imports into China.
Well, I think my range would be more sort of 10 to 11 and a half. Okay. I think they're quite capable of dropping back to that closer to 10 if they think the prices have risen a bit too quickly for them. So if you actually look at the beginning of the year when they were paying the price that had been rising towards the end of last year, they trimmed back their imports quite significantly. The first quarter was very weak in China. It's only picked up in the last couple of months when you've had a declining price trend since about February onwards. So if you just work on the physical lag of when cargoes are arranged and delivered, you can actually track a very close price correlation with China imports. The rest of Asia is not quite as obvious, but even India tends to pull back when they see prices going up too much. or they switch their suppliers, so they'll buy more from Russia. They'll, try to get cheaper crudes into their mix because they're quite flexible. So, I'm not seeing a spike in demand. And if there is any extra demand, it appears to me that it's largely inventory building in China. So I'm not quite sure where all this bullish case comes from. It doesn't really fit with the reality I'm seeing on the ground.
Laurie Hatayan, MENA Director at Natural Resource Governance Institute. Laurie, perhaps it's the geopolitics is back. Is it the end of Trump's love affair with Putin now? They seem to be sort of casting insults at each other. I've never seen Trump actually sort of throw something that resembles an insult at Putin, but he did yesterday. Is this a geopolitical sort of push up, a support for the oil price? That clearly there's no end in sight now for the Russian war on Ukraine, and obviously the Israel war in Iran looks more like a pause than an end. Your thoughts on geopolitics playing an upward lift on this oil price back to 70?
Definitely, you see that there is no end to any story. And definitely when President Trump came in, he said like, oh, a couple of days and I'll be fixing all the problems of the world, and then I'll get a Nobel Peace Prize, and we are going all to live happy ever, and then the economies will boom in the US and everywhere else. And after almost 6 months or so, we see that where are we? No resolution on the Ukraine-Russia. We see, on the contrary, some escalations. And then the same we see, like we had a 12-day war in the Middle East, almost like between one having a nuclear bomb, the other maybe trying to have a nuclear bomb. And then Gaza is not ending. So you don't see any end to any problems. And all of these, they do have an impact on the market, because Russia is an exporter of oil and gas. Same with the Middle East, with everything, with all the drama or no drama that we saw, but definitely anxiety that we saw when the war was going on, and about the security of supply. So all of that, I guess, is still there, that we don't know what will happen. Today, Netanyahu is in the US. Every time President Trump meets with the Bibi, we're like, okay, what is going to happen in the Middle East? Where will it like escalate?
You know we're in an upside down world when a war criminal hands Donald Trump a letter that he submitted for him to be a nominee for the Nobel Peace Prize. I mean, you know the world is upside down when something like that happens in the White House.
So basically, because of this situation that is like no end to any of the crises, this is part of, I guess, the why we are seeing what we're seeing in the market, and that this is a part of it, I guess. Like there are parts of it, but this is like no end to the crisis in the Middle East, in Ukraine. Russia is putting pressure on the market.
Maliha, I mean, when we start this second half, obviously the first half was full of the turmoil and disruption of the return of Trump and all of the pieces that were included in that. But yet still equity markets that are at a record. I mean, equity markets just can't find every day the next record. Where inflation is really, there's no kind of trauma inflation coming from this tariff threat and tariff war, which doesn't look like a war. It looks like a threat, and that never sort of gets across the line here. I mean, is the headlines much worse than the reality that the US economy is still adding lots of jobs? The European economy with a very strong euro. China, as mentioned there, is still in fairly decent shape. Nothing to look at here, really.
You're absolutely right. The truth of the matter is that we haven't really seen any impact of the tariffs right now. Q2 numbers are coming out right now in the next couple of weeks. It'll be very, very interesting, because usually a tariff impact takes about maybe 4 or 5 months to hit the tape. So we'll start seeing companies talk about potential either margin pressure or cost pressure, consumer pressure. But to tell you the truth, back in April, there was a threat of a recession. The US economy has been holding in really well. Obviously, the perception of a massive trade war with China and supply chains coming to a complete halt is what took the markets down. But if you look at the forward earnings, they haven't really moved. They've actually held really well. So the markets are recalibrated and went back up. Now you can argue that the valuation multiple was, 10-15% discount. Now it's looking fairly valued. This year, the equity markets will be range bound. We have the downside support between healthy corporate balance sheets. The labor market, as you said, is very strong. We saw NFPs of plus 149,000 last week, and the unemployment rate's 4.1%. But on the upside, we're not seeing any earnings growing much above what's already priced in. So markets in a bit of a range bound. Having said that, there's a lot of pressure to Fed to cut rates, and the market's off on the belief that the Trump's going to get his way. But there is no reason for the Fed to cut rates. So the perception of liquidity is supporting equity markets right now, but they're not going to be making newer highs because earnings are not going to grow anymore. They're plateauing. So we're not bearish, but we are right now cautiously optimistic because a lot of the good has been priced in. But the US economy is holding right in. The whole trade of US exceptionalism is still quite alive and well. The large cap companies are doing well. You've seen the capex numbers from the big tech companies, spending on data and AI. So those things are doing well, but the smaller mid cap companies are still not doing well because I think debt and interest rates are a big concern. Refinancing this year is going to be a huge concern as rates are 4.5%. A lot of company US debt needs to be refinanced this year, and the yields are already too high, and the Fed's not cutting rates. So I think that's much more important, which is why the markets are range bound. But we move from extreme pessimism to extreme optimism right now. And the question is, this is like, where do we go from here?
If it's Monday, it's optimism. If it's Tuesday, it's pessimism. It's sort
the
of
last 2 days, we've seen Trump go back on his tariffs again. So China's making threats right now. US is making threats. So at these levels, you are being paid to not be long the markets, right? But back in April, there was a lot of pessimism. So it's all about the risk reward right now. But there's still a lot of uncertainty, and the issues have not been addressed in terms of tariff, US debt, refinancing, interest rates. And now earning, we're going to see a lot of commentary on margin pressure, and that'll be very important for the equity markets going forward.
Clyde, maybe $70 Brent is the new 65, right? Given the collapse in the dollar, 14-15% drop in the last number of months, the buying power of the dollar falling off a cliff in a way, that given the weak dollar, that they're obviously in Asia, where much of your region there, people love that. How do you see the role of the weak dollar in elevating this oil price?
Well, I think it's almost something that we don't really focus enough on when we're talking about oil prices, because we always talk in dollars, but very seldom do we actually talk in sort of what are the retail prices that people are actually paying. I mean, I'll just use a little example. Petrol at my local server in Australia is substantially cheaper now than it was 6 months ago. So I'm a beneficiary of that kind of stuff. So even though the crude price might be $70 in US terms, in Australian dollar terms, it's lower. So yes, you're right. I think that's something that is worth focusing on and having a look at. My whole thing is that Asia, to me, always strikes me as a price-sensitive region, not so much Australia, but the developing Asia. And if prices in local currency terms are going down or steady, then that will, send a demand signal at some point. It just takes a long time for these things to actually work their way through the system. It's much like, you talked about, we haven't seen much impact of the tariffs. That's still coming. All of those bad things that tariffs are going to do are still coming. And they're not going to hit within the next couple of months, maybe not even the next 6. It's more like a year out process for all that bad stuff to be priced in. It doesn't matter one thing I think that the market is, particularly equity markets, are just really missing is at the end of the day, we're going to end up with a much higher tariffs on imports into the US than we had before Trump came into power. Whether your average tariff rate ends up at something like 17% or 15% or even 20% is kind of irrelevant. It's going to be way higher than the 2-3% it was before. And that is bad news. There's no other way to spin it. That cannot be good.
How is that? How big of a fracture could that be in Asia, Clyde, with this sort of efforts that we saw with Vietnam, that the Trump administration sort of trying to close off supply chain routes for China by imposing double, I think it was 20% for Vietnamese goods into the US and 40% for any sort of throughput they would facilitate. How big of a fracture? China warning other trade partners not to succumb to US pressure on that.
Well, I think you end up with a whole bunch of extra costs working their way into the system, in addition to any actual tariffs. You've got compliance costs, you've got people working around things, you've got all sorts of dodgy dealings going on the back. I mean, we know from our experience in crude oil markets that oil traders are really, really good at getting around sanctions and things like that. I imagine you're going to find out that people who make sneakers are just as good at doing it. They'll just find clever ways of doing it. And that's how markets will in some ways respond. But at the end of the day, it's going to put pressure on a lot of Asian economies. I mean, if he's genuinely going to hit his best friends in Asia, like South Korea and Japan, with 25% tariffs, what is the impact of that? How does it make Japanese and South Korean people feel? Are they likely to go visit America? Are they likely to buy American goods? God, no, they're going to do the exact opposite. I mean, I see this in Australia already. People are saying, how do I stop buying American stuff? So there's an unspoken cost to the trade war and the tariffs and things like that. And I think these are things that your average Wall Street equity trader is just so blissfully unaware of, but it's going to come back and smack him eventually.
Laurie, looking at Europe, obviously a number of things there perhaps playing into support of the energy markets is the huge amount of new fiscal budgets for, let's say, defense, up to 5%. The German $1 trillion clearance to go into further debt in order to finance defense and other spending. Where is the sort of that kind of scale of European spending that could be driving extra support and liquidity into the European economy? And is that real, or is that just a headline to get Trump out of their hair?
Look, no, I think like they're taking it very seriously. And then because at least like from what we're hearing, like this is very important. And not because of, I guess, not because the President Trump is pushing that you need to take your security into your hand and spend the money, and for you to find where to spend, from where to get the money to spend it. But they do feel the heat that like this war in Ukraine brought back all the traumas of the past, and then how to work on their own security, and how to push even the people of Europe even to fight for their country when there is a need for them to fight that. All of that has been something that was from the past, and Europe was living in this EU bubble, and then all of that stuff, and now they have to
They'd let go of all of their. They'd let go of all their national service programs. And
definitely. So then you have like to rehabilitate the people of Europe, that, okay, there are this hard security stuff that are reality, and then we need to think about this. And you see here and there in countries that they're preparing themselves for potential wars, all of that. So the money is going to come from somewhere. So basically what is being of concern is like, is it going to be less on social security stuff and then more on security, and therefore you will have a different way of state society dynamics in Europe, and then that's the big concern about where this is going, basically. And that's the kind of the debates that
well, if they're going to rebuild a military capability, 3.5 to 5% spend of GDP, they're going to have to build up an industrial capability to make weapons. They can't be relying on the Americans or others to supply those weapons. They're going to have to build up their industrial capability to do so, right?
So basically, that's definitely, and then they're working on complementing each other, because like the EU as one EU. So what can let's
Germany
say
makes good
Spain
tanks,
do exactly?
and
What can Spain do? Some industries to transform and to become more of building some of the stuff. So they're tapping into their own each country's, if you want, abilities, and then it will bring back some, if you want. Basically, they were talking about bringing competitive industries that were more on green, etc., etc. Now they're more into talking about like these military industry. And then definitely France is good because it has the infrastructure, building all these planes, etc. So I think they're tapping into, okay, who can do what, so that as a unit they work together on it. So it's more of a collective thinking rather than like just like Germany wanting to protect itself or other individually protecting themselves. So it's a collective effort that they're doing, but each putting this money into it, and then it will have an impact on their, if you want, country social impact, but collectively thinking about having this military industry, bringing it back, I guess.
Well, it's certainly the penny is dropping with everybody, and it's obviously clearly being displayed by Putin that this war is not going to end anytime soon. Any leverage that Trump thought he had is gone, and now we're probably into another. It looks to me like it's ramping up to another level. Let's go to the survey question and sort of see where the rest of the room is on this wider question that we've been discussing. Last month, Israel's war in Iran drove Brent crude to 70 plus. What is the biggest driver in July? U.S. rig count at 4-year lows. As they say, low prices is the solution of low prices. Stops oil drilling in the U.S. or higher cost production. OPEC Plus at the end of the day are not adding that much, even though there's lots of headlines and quota increases and a big bumper quota increase over the weekend. Oil prices rose on Monday. OPEC Plus not adding much. No tariff war yet. Ultimately, there's a lot of headlines, but there's actually, we've had moments. We have higher tariffs across the average, as Clyde says, but no real impact yet. Or 4, weak dollar. We've seen the dollar is probably the most tangible with rig count down. Weak dollar down about 15% over the last few months. So the new $70, the new 65 is 70. Or that's the idea. The weak dollar inspires a higher oil price. There's probably 20 other reasons we could put on the list, but c'est la vie, you've only got 4. Malia, looking at the sort of self-fulfilling nature of things here, that in the absence of any logical reason, there's just the liquidity ocean continues to search for a return every day, and that's lifting all markets. Oil is a laggard, really, when you think of everything else. And so no surprise, oil might be joining the party a little bit at $70 and a weaker dollar. It looks still cheap. Your thoughts on the liquidity ocean being the answer for all of these sort of new records?
That's a really good point, Sean. If you take a look at global M2 money supply, it's been massively going up every single day, right? So central bank liquidity globally has been picking up in terms of stealth QE or Q rate cuts. We know liquidity drives asset prices, and that's actually helping the market, S&P and bond markets doing really well. It eventually then filters into Bitcoin and other sort of assets and commodities. And I think eventually it will go into oil. But oil has been lagging because, commodities are run by demand supply models, inventory balances. We don't have a shortage of oil. There's a lot of supply sitting on the sidelines. So compared to, let's say, gold or silver or maybe even copper, it will lag because there is a supply surplus. But eventually you can argue that commodities can get the macro tailwind, but effectively demand supply fundamentals rule commodity markets. So at some point prices cap because the fundamentals of physical flows take over. And that's a premise. We think the macro speculation is taking commodities higher, but then eventually the physical market's going to, place a discrepancy as to which one will do well. So we're not bullish on oil. We don't see, as Clyde says, we don't see the demand pick up at all. It's a lot of macro speculation, weak dollar, Fed cutting rates and all that stuff, M2 money supply taking it higher, and inflation will be an issue. The Fed's talking about cutting rates. No, we are confused as to why the Fed is even talking about not raising interest rates, because the economy is doing well. Inflation's anchored at 3%. And if you talk about much more fiscal spending and less cuts to spending, we should be looking about raising rates. But the Fed keeps talking about cutting rates. So all this.
I think if he talked about cutting rates, Trump would send the stormtroopers down to the Fed and probably arrest him.
And the new two shadow chairman, they're looking to instill are going to be much more dovish. So the market's thinking about the future, about lower rates, easier monetary policy, and that's why commodities are getting a boost. So I think it's very, very speculative at this time because there is no demand increase to justify the price increase from an oil perspective.
Clyde, looking at the big headline overnight, 50% tariff on copper, the latest sort of headline grabbing announcement by the Trump administration. Uh, what's the fallout from that? Who's going to get kicked in the shins with that?
Well, that's kind of interesting. I think ultimately the U.S. consumer gets, has to wear that. The scope to expand copper production at a mine level in the U.S. is very limited. Yes, there are deposits that can be exploited, but it takes, even with the most permissive permitting regime in history, it will still take 5 to 6 years to build a mine. So, you're not going to expand copper output much in the US. You can run existing mines a little bit harder, yes, and that kind of stuff. It's not like there's a whole bunch of mothballed smelters waiting to receive copper in America either. So it's not like they could import raw ore from other places and smelt it in America. That's not really going to happen either. So all that really happens is, for what copper America needs that it can't produce itself, it just pays 50% tariff, and then that gets filtered through to the price of goods that Americans have to pay. So I think this is absolutely fantastic news for major copper producers, because they're going to win out of this. But
in what sense? Like how?
Well, the copper producers inside America.
Oh, inside America, yeah,
prices. The ones outside America are maybe going to struggle a little bit. But basically what happens is, Trump's dream of a manufacturing renaissance, this is the sort of thing that actually drives manufacturing out of America, because it just adds to their costs. So you've now got 25% on steel, 25% on aluminum. If he does do 50% on copper, if you're actually making something that uses a lot of those, like cars or anything electronic or anything, those kind of things, fridges, that kind of stuff. If you're doing that in America, it's just becoming more and more expensive. So, Trump believes that everybody's just going to eat the tariff. Actually, no, the person who ends up eating it is a consumer in the end, one way or another. And even if companies do say, okay, we're going to cut our margins, what does that mean? They pay less tax, they hire fewer people, they invest less money, because they just don't have it. So even if you somehow absorb the tariffs into corporate profits and whatever, it still ends up hitting the economy. It just takes time. And that's, I think, where people expect these things to happen really quickly. They're not going to happen quickly. It's a slow burn. It's uneven. It hits different sectors at different times. But at the end of the day, it's just all bad news.
I wanted to get your views, Clyde, on a comment we had earlier this week from a senior Chinese analyst, China-based analyst, who was saying that the tariffs have been a blessing in disguise because they're accelerating the change in the economy that China needs to make. I want to get your views on that sort of concept. Is that a valid statement or just spinning?
I think it's a very much a glass half full type statement. Yes, if you think about it, what is China doing right now? It's quite clear that they have a very different vision of how their economy is going to run in 20, 30 years' time to what Trump has for the US economy. So China's basically electrify everything. In some bizarre way, coal is their transition fuel, because they're using coal to electrify as fast as they can while they build up their renewables. What China doesn't want to do is they don't want to import fossil fuels. They hate what happens in the Middle East. They hate being reliant on fundamentally what they see as unreliable countries and partners. So they want away from that. They'll use their coal, they'll build renewables. So yes, it does accelerate that sort of process. And that's probably why the Chinese economy isn't as bad as Westerners tend to think of it as, because they're manufacturing a lot of stuff for domestic consumption. And they are trying to move away from that export-based model. But the point is, they can't do it that quickly. They're going to be reliant on exports for some time. So that's where it hurts. If they are facing higher tariffs, it is going to hurt their manufacturers. And it takes time to change that, how they're working that economy. I tend not to think of China as a huge supertanker type economy that's difficult to turn around and shift. I tend to think of it as a 100,000 little sailboats. You're all trying to get to sail in the same direction. Some are going off in other ways, but turning enough of them into the right direction, that's what they're trying to do. And, it's a brave man who bets against that.
Laurie, last word with you today. I wanted to get your insights or thoughts about the censure of Ursula von der Leyen in the European Parliament. Is this a minor event, a sideshow, or what is happening within the dynamics of European politics? Are they finally waking up to the fact that Ursula von der Leyen has sold out their morality to the Israelis?
What a question to end.
No, but why are they going after her ultimately is the question.
Look, I don't know what they want. It's like I think there is a shift into like in politics, like EU wants to be more political, more geopolitical, as she said in her first term, but they never were able to make it. Now they feel that they are becoming more irrelevant in international politics, and this is what they don't want. So individual member states are being very aggressive and assertive in politics bilaterally, but they don't see that the EU is following through. And that's, I think, like what the pressure is. They want it to become more political, more assertive, more playing a role than just paying and not playing a role in politics. And that's the struggle. And you see all these right-wing governments in one direction, and her and the group of the political parties that she is part of in a different direction, like in some kind of lost in between. And that's the kind of thing. They do want to be relevant. They see they're irrelevant when it comes with President Trump talking to Russia and not taking into consideration the EU's the EU's security or national interest. Or the EU's interest. They see the same in the Levant, what to do with the Israel-Palestine situation, irrelevant. When Iran, Israel, irrelevant. So they cannot keep on being irrelevant when everything has an impact on them as well. So that's I think, the big thing that is happening in the EU, and now with all the pressures that they have on spending more on military, on security, and maybe less on the green. And then you've seen even like now, yesterday, 2 days ago, they expanded, like they on the storage policy, the gas storage. So they expand, they post like until 2027. They expanded it to 2027. But again, they said that you don't have to fill the storage by the November, but by December, so that we don't put more pressure on the countries and the companies that are bringing in the gas for the storage. So all of that stuff, there's a lot of pressure, I guess, going on, so that the EU becomes more relevant and not just sitting on the side of history and watching what's happening.
And absorbing the consequence. It seems that one of the other things that's happening you hear about is that the stronger euro, is this a moment for the euro to go global? Can it become a global reserve currency because of the sort of macro weak elements around US sovereign debt and the weak dollar? So anyway, in this room, nearly 2/3 think the weak dollar is the driver this month for oil prices up to 70. We will have to wrap it up there. I want to thank you guys, Clyde Russell, Maliha Bengali, and Lori Hatayan, not only for today, but of course for your participation all this season. It's absolutely wonderful to have your voice every month as we wrap up this week, the end of the 24-25 season. Have a great summer. Hope to see you all again in September. And please, if you can, join us in Fujairah for our annual in-person forum on the October 1st and 2nd. But until then, have a great summer, and we'll catch up with you all soon again. Thank you. Bye-bye.
Thank you very much.
Enjoy your vacation.
Shukran. Ma salama.
Pew.